Welcome to our first CIOView of 2017. This looks like another year to be dominated by politics. In the US, the new administration is still struggling with the realities of politics, while a heavy electoral calendar looms in Europe. We would caution against drawing broad conclusions from either the Brexit referendum and Donald Trump's election. Every vote is different because every country is different. Capital markets tend to react to elections strongly only when they bear economic consequences. In France, most fear negative fallout if Marine Le Pen wins. However, our base scenario remains a victory for a reforming candidate, which could provide a boost to the French economy. We expect global growth to accelerate in 2017. It remains to be seen, however, whether the US will reinforce this trend thanks to tax cuts and deregulation or slow it due to protectionist measures. For now, the new administration appears to be struggling with making progress on its legislative agenda. Putting America first is harder than it sounds when it comes to turning back the clock on globalization. Central banks are also likely to keep an eye on political developments throughout 2017. The US Fed will carefully monitor whether the Trump administration reinforces inflationary pressure through deficit spending. After all, his economic stimulus program would come in an already mature stage of the cycle. We currently expect up to 3 further US rate hikes by the end of the first quarter of 2018. The interest rate gap compared to the Eurozone and Japan therefore looks set to grow further. This underpins our call for parity between the dollar and the euro. In Europe, the ECB will be mindful of the political context in view of the elections. Despite this, we would expect the tapering discussion to intensify during the course of the year. Overall, the world's major central banks should remain accommodative in 2017. They still have scope to do so as recent rises in inflation look set to fade again in key economies. We expect 1.7% inflation in the Eurozone for 2017, but only 1.5% in 2018. Accelerating economic growth, moderate inflation and limited interest rate rises are normally an ideal combination for financial assets. Right now, however, it is hard to find an asset class that looks cheap by historic measures. That does not mean, however, that this is time to get out of the market now. We are not seeing the typical signs for the catalysts that start a substantial market correction. We focus on attractive dividend yields, attractive business models, and attractive markets. And we do so globally. We use market corrections to build up positions on the back of a solid economy and expected earnings growth in 2017. For bonds, we prefer short maturities. We favor sovereign bonds from the European periphery and emerging markets, as well as corporate bonds by US and European issuers. We continue to recommend a broad diversification across asset classes and geographies while managing the portfolio actively.
Discover more at deutscheam.com.